on the FDIC, what they did is they collect in little fees from bank accounts, and in 2008 the insurance fund was at $53 billion. It still actually has money in it today, but over the last few weeks they've had to really kind of resort to using bailout money and then special assessment fees to keep them above water. Technically, they've run out of money and they're just kind of bringing in extra. So the FDIC itself, they're just there kind of for show, for people to believe, well, our money is still insured. But in reality, what we're at, and I wrote about this earlier, there's an article on the website called Yes, Virginia, There Are No Reserve Requirements, where our monetary system is right now. We used to have, you could argue about it, how it's fraudulent, and it is, but fractional reserve banking, which we had for many years, and has been practiced really by bankers around the world for a couple hundred years, that fractional reserve banking has broken down here in the USA, and there are no reserve requirements anymore. And what I point out in the article is that we're down to a paper ticket system, so we're just creating money out of thin air. And one of the things that's just so fraudulent in my mind, and to put it in terms for people that I go around and meet, is, if they work their whole lives, 40 or 50 years, a lot of them, if they're lucky, they'll make, $2 million, $3 million, whatever the number is. And what ends up happening is, they work their entire lives for that money and that purchasing power. Maybe like half of it gets stolen by the government through the income tax and what have you, but that's their whole lives. And when you talk about the Federal Reserve, they can just create that with a click of a button, and they're doing that every day. And it's criminal. In some ways, it's keeping, like you said, the whole system afloat, but it's only going to make the correction that much more harsh. So what the claims that the FDIC has, if you look at it, they say they've got $10 billion in their fund as of June 30th by pumping in $10 billion of this extra money from elsewhere. They actually did hit zero, it looks like, or they would have hit zero in Q2 if they hadn't done this special pump and fee. And they've already had $5 billion, well over $5 billion, or probably at $6 billion, $7 billion of failures in this quarter. So, they're just going to keep the whole charade going on the because it helps. The truth of the matter is it helps keep the public confident. But if they started looking at the numbers and saw, well, our all of our deposits in the entire U.S. Are $9 trillion, and that's with a T, so that's 9,000 billion, and you're saying, well, we got this, $10 billion to kind of backstop it. When it's just a small fraction. So what a lot of people also don't realize is that, out of all the money that we have, or all of the dollars that exist, most of them are just electronic. I think it's something like, the monetary base is somewhere around, or a currency is like 800 billion or so. So you take 800 billion out of that whole amount, you're somewhere at right around 10%, and then only a small fraction of that is actually coins. And that's all over the world, because I've traveled, I've lived over in Asia for a bit, and you walk around, and I remember as I was leaving China, a taxi driver wanted me to give him renminbi for a $100 bill. And I was like, no way, you keep the $100 bill. But these people kept it because they believe, it has value. It has purchasing power. And in the monetary sense, they are correct. It is monetarily scarce. But unfortunately, with the dollar, it's also the world's reserve currency. And let me explain for your listeners what that kind of means is, if India and Thailand are trading goods, they won't use the Thai baht or they won't use the Indian rupee. A lot of times they'll use the dollar between the companies. So it's kind of like you said, the entire world is on this unbacked fiat currency, but the dollar is basically still the anchor for the whole system. And when, if foreigners, you can talk about Americans losing confidence in the dollar, but it's actually not in our hands. It's also in the foreigners' hands that hold all these dollars. And if they lose confidence, what are they going to do? They're going to try to buy stuff with it. And to some degree, Yeah, to some degree that's already going on. Like, China holds a lot of debt, and what's pretty hard to find out, but all the signs are there, is that China is taking our treasuries and, buying commodities in Africa and all over the, in stocks of companies with them. There's very few ways to track, what China is actually doing. But I'm watching the Treasury market pretty carefully, and it's there in the dollar that I think that's actually the next bubble. Yeah, well,
the whole economy. But.
Yeah, and kind of what I'm curious to see is if we actually will have something slow, or whether we'll just have something, like a currency event that happens very, very quickly. Like if you talk to, or if you read any of the accounts of hyperinflation, whether it was, Georgia in the 1990s or South America, Argentina, or if you go back to Germany during the Weimar Republic back in the 1920s, what sticks out from that is the crisis hits so fast that, there's no time really to do much. And, in today's world, the kind of the only thing that I could see that they could do is they could put fixed exchange rates back in. So, like $1 equals, 2 euros or whatever it happens to be after it slips. But even that would fall apart very, very quickly, because you'd have different governments inflating at different rates, and it would be pretty chaotic. But the Treasury market, I guess for the listeners, the Treasury market actually isn't all that large. Pretty much the way it works is, for every dollar of national debt, or roughly for every dollar of national debt, we have $1 worth of Treasury bonds issued. So there's somewhere around $12 trillion of treasuries issued out there. But close to half of that, 45 to 50% of that, is owned by the Federal Reserve. So what happens is, that interest, what a lot of people don't realize is most of that interest is actually returned to the United States government every year, and the Fed uses some of the rest of the interest to run their operations and pay their salaries, which is actually pretty steep, and to also pay this dividend out to their shareholders. And actually, we're talking only about $3 billion there, which, only $3 billion, but it is actually kind of small compared to everything we talk about right now. So the Treasury market, and to give some folks some scale, is, the entire GDP of the U.S. in 2008 was about 14 to 15 trillion U.S. dollars. The size of the world GDP was 50 trillion U.S. dollars. The size of the equity markets and the stock equity and bond markets, so stock and bond markets, was about 75 trillion. It fluctuates. And also the property market, every single property on the surface of the planet, every single building and all the plots of land was valued at roughly also $75 trillion. And then you get into things like the derivatives markets, which are, exchange-traded derivatives were somewhere around $100 trillion in notional value. So that's a bit different than, having an asset, because derivatives are not assets. They're just instruments of debt. But the over-the-counter dark derivatives are about 600 trillion U.S. dollars. And those are kind of figures that start boggling your mind a bit. But one of the things that's one thing is it is a large market, but it's not like, a huge market. And sorry, just taking a sip of water. And the second thing is actually that I want to say is with Ludwig von Mises, a very famous, well, actually not so famous in today's academic circles, but probably one of the greatest economists who ever lived. And in 1949, he wrote a book called Human Action. And in that book, he actually talks about the sovereign debt market. So not necessarily the U.S. Treasury market, but just every sovereign debt market. And, what is the Treasury market, or why would people invest in the Treasury market? And the reason is this: they don't want to. They are satisfied with getting a slightly smaller interest rate as compared to investing it in the actual marketplace. So they get a small break, but they have, the security, quote unquote, security of the state to, pay them back that purchasing power with that interest over time. Now, here's the thing: how does the state get that money?